Jeremy Miller, Warren Buffett's Ground Rules, Words of Wisdom from the Partnership Letters of the World's Greatest Investor. Tap into the wisdom of Warren Buffett, one of the world's greatest investors, as we explore the highlights of Warren Buffett's Ground Rules by Jeremy Miller. Discover the secret to Buffett's $88.9 billion fortune: patience in investment. Learn the fundamental difference between investment and speculation, and how a focus on intrinsic value and long-term growth can lead to substantial rewards. Understand the importance of measuring, monitoring, and being patient even in times of uncertainty. Get insights into Buffett's preferences for undervalued companies and how his investment style evolved over the years. This summary will help you develop your own expertise on careful, methodical investment strategies.
The key to Warren Buffett's fortune. Learn Warren Buffett's investment philosophy, careful assessment of value and patience. Have you ever been confused about the difference between investing and speculation? The renowned billionaire Warren Buffett has a simple answer for you: careful assessment of value. In his investment philosophy, buying businesses based on their inherent value and waiting patiently for the market to adjust to their true worth are the key ingredients for success. Buffett's approach is rooted in the belief that the price of most financial assets eventually aligns with their intrinsic value. As buyers of stocks, investors acquire a tiny fraction of a business, which should reflect the company's performance over time. If the business thrives, so do the investor's profits. However, if the business loses value, the share price drops, and the investor waits for the market to correct itself. The key is to concentrate on what the market should do, not when it should do it. Instead of obsessively following unpredictable market fluctuations, investors who buy shares in undervalued companies and patiently wait for the market to recognize their real value will make a profit. Investment success, however, demands a considerable amount of patience. Compound interest, the process of reinvesting gains continuously to earn more returns, is an excellent formula for long-term investments. It is the key driver of value rather than rapid speculation. Buffett's investment philosophy is illustrated through an anecdote regarding the French government's purchase of the Mona Lisa. If King Francis I had invested the purchase money at a 6% compound interest rate, France would have had $1 quadrillion by 1964. In conclusion, careful assessment of value, patience, and trust in compound interest are three of the cornerstones of Buffett's investment success. If you aim to follow in his footsteps, developing your own investment style will require these fundamental principles. Measuring like Warren Buffett. Successful investors compulsively measure to achieve their goals and to determine if they're on the right track. Warren Buffett advises that monitoring investments, keeping track of past performance, and measuring against the market are key elements in investing. Warren Buffett, one of the most successful investors in the world, has always been confident in his abilities. As a young fund manager, his focus was on growing his fund at a faster rate than the market, which he saw as his main competition. However, it wasn't as easy as it sounded, and he had to measure his results regularly to achieve his goals. The key message in this book's summary is that successful investors compulsively measure. Measuring performance against past results and the overall market is essential to determine if you're on the right track. Although it can be challenging, careful measurement, clear-eyed analysis, and a steady hand are the only ways to succeed as an investor. Buffett advises that knowing what to measure is just as important as measuring itself. You need to monitor your investments every day, keep track of how they're doing relative to past performance, and be patient when your chips are down. It takes energy, commitment, and honesty to succeed in investing. It's essential to measure your results against the market, too. Even if the market is down, if you're slightly less down, it still counts as a win. Buffett also mentions that it's easier today to beat the market thanks to the introduction of index funds. These funds combine slices of many different companies on a given stock exchange, making their returns broadly match the gains and losses of the overall market. Buffett recommends index funds for those who don't have the time or energy to devote to their investments. Otherwise, compulsive measuring is the only way to determine how you're doing. It's essential to know when to hold M and when to fold M. In conclusion, measuring like Warren Buffett is essential to achieve your investing goals. It takes energy, commitment, and honesty to monitor your investments daily, keep track of past performance, and measure against the market. While it can be challenging, it's the only way to succeed as an investor. Investing style for young investors. Developing your investing style and focusing on undervalued companies can lead to significant returns as a young investor. Warren Buffett's success through investing in generals and nets highlights the importance of patience and determining the value of a company. As a young investor, it's crucial to develop your investing style. Your investing style should reflect your personality, goals, funds, and especially your competence set. This means that you should avoid investing in industries or assets that you don't fully understand. Instead, focus on undervalued companies, which Warren Buffett refers to as generals. When Warren Buffett started his fund in 1956, he had just over $100,000 to play with, and he attributed his incredible rate of return to his focus on small, relatively unimpressive investments. He favored buying fair businesses at wonderful prices, which means middling quality companies priced under market value. Buffett also looked for companies that were worth more dead than alive, which he called nets. While investing in ultra-cheap stocks and nets may not seem glamorous, Buffett found that they provided the best average returns. As his success grew, Buffett began focusing on the quality of a business and whether its earnings could be sustainable. He transitioned from buying fair businesses at wonderful prices to buying wonderful businesses at fair prices. As a young investor with less money, you have an advantage over investors managing huge funds because you can invest in small companies not listed on the stock exchange, making big percentage gains. Once you're managing more money, you need much bigger deals to move the needle on your overall results. In summary, new investors should focus on buying shares in undervalued companies, like generals and nets. This requires patience, along with skill at determining the value of a company. As investors gain more experience, they can transition to buying wonderful businesses at fair prices. Buffett's early lesson in risk and reward. Warren Buffett's early experience of buying and selling Coca-Cola bottles to his friends taught him a valuable lesson in assuming risks in familiar markets to earn rewards. He unknowingly practiced arbitrage, which involves capitalizing on the price difference for one product in two different markets. Buffett's specialty in merger arbitrage involves buying stocks in a company at a lower price and betting on its increased value after merging with another company. However, this form of arbitrage requires in-depth knowledge of the businesses and markets involved, making it a risky choice for average investors. Alternatively, investors can acquire controls, large enough pieces of public companies that allow them to influence operations, although this may lead to confrontations with existing owners and board members. Buffett moved away from controls due to the potential messiness involved but never abandoned his core investment principles that led to his remarkable success. Investing against the crowd. Investing against the majority can be a challenging strategy, but sticking to your principles and understanding the whole picture is crucial for success. This is exemplified by Warren Buffett's ultra-conservative approach, which led him to predict and profit from the market crash while others failed. The key takeaway is to identify your core principles and stay true to them, even if it means going against the crowd.
In conclusion, Warren Buffett's Ground Rules offers valuable insights into the mindset and strategies employed by one of the world's most successful investors. The key takeaways underscore the importance of patience, careful assessment of intrinsic value, and the difference between investment and speculation. Develop your skills in monitoring and measuring your investments, keeping in mind that the rewards of compound interest are best reaped in the long term. Learn from Buffett's focus on undervalued companies and his evolving investment style. By applying these principles, even first-time investors can stand to gain significant rewards and create a foundation for lasting success in the world of investment.